Good morning, good afternoon, everyone. I'm Brian Pascoe, the Chief Executive Officer of International Capital Market Association. Technology is reshaping the way financial markets operate, from how instruments are issued, traded, and settled, and managed throughout the entire life cycle. The adoption of new technologies has the potential to impact market practices and market structure significantly. In line with ICMA's core mission to promote resilient, well-functioning international debt capital markets, we see innovative technology and fintech developments as further opportunities to develop strong market practices. Fintech continues to be a key topic for ICMA and our almost 600 members across the entire value chain of the international debt capital markets, whether public or private issuers, investment banks, central banks, asset managers, and other investors, as well as market infrastructures and other providers. Technology solutions across the spectrum of issuance, trading, and operations in bond and repo markets continue to expand. ICMA's directories now cover over 300 different vendor solutions. ICMA's fintech strategy comprises three principal components. Firstly, providing market intelligence to members and increasing transparency on technology developments. Secondly, bringing market participants together with a view to promoting common standards and best practice. And thirdly, engaging with regulators through working groups and bilaterally. Our engagement is guided by the Fintech Advisory Committee with strategic priorities for 2022 focusing on the following. Firstly, supporting the electronification of repo markets and promoting interoperability by extending the common domain model to open repos, floating rate repos, and evergreens. Secondly, promoting interoperability between the ever-growing vendor solutions and supporting automation in primary bond markets by developing a common data dictionary. And thirdly, exploring market guidance to support liquidity in digital DLT-based bonds, with a focus on legal and operational aspects and demystifying digital bonds. Today, we will hear about how data is driving digital transformation, the latest regulatory and supervisory challenges for digital assets, and dig deeper to understand what are the remaining barriers to wider adoption of new technology developments within wholesale capital markets. Increasingly, firms and regulators are exploring how they can further leverage data and interact with new technologies to offer new products and become more efficient. We're also aware of the risks posed and gaps that remain around interoperability, and in other cases, the legal or regulatory uncertainty to enable greater adoption. I think we can all agree that there are many questions to explore here on the relevance and impact of latest developments on bond and repo markets. There's no doubt these developments will fundamentally change the markets in which we are embedded. It's within this context that we are delighted to be hosting the event today. We will hear from Céline Le Cotonec, Chief Data Innovation Officer from the Bank of Singapore on data and digital capital markets, followed by a panel moderated by Armand Peter, Chair of ICMA's Fintech Advisory Committee and Head of Sustainable Banking at UBS, on the broader topic of leveraging latest fintech developments in debt capital markets. I very much hope that you will enjoy the event, and we encourage you all to raise any questions through the platform's Q&A functionality. Now let me hand over to our first speaker.
Hi everyone, my name is Céline Le Cotonec, and I'm the Chief Data Officer of Bank of Singapore. Very happy to be joining you today in this ICMA FinTech Forum. I have built up, an overview presentation of what data mean and data disruption and how do we manage data, what is our strategy in Bank of Singapore and the good outcome that you could potentially use for your organization. I'm free and available to answer any of your questions using the Q&A function. With that, I will start my presentation. So first of all, we've been talking, AI is a buzzword, right? You're talking about data, big data, a lot of the vocabulary that I came, mainstream within the past few years, right? But my point here is that AI is not something new, right? It's been something that has been built as early as in the 50s. In the family of artificial intelligence, you got different type of model, right? You have what we call machine learning model, where we're actually training the machine to be able to take decision the same as human. And then, more complex use cases such as deep learning, right? That could be used, for example, for image processing that are using a lot of compute power and tremendous amount of data. This is the type of AI that is available in an autonomous car. So yeah, nothing new, nothing fancy. What has changed is now the availability of the storage at the lower cost and the availability of the compute and the tremendous also collection of the data that we are having today, thanks to the digitization of the platform, with the overall digital transformation that most of the industry have gone through. We are able to collect much more data. The arrival of Web 2.0, you have different type of data about how users are interacting with the platform, the content that they are generating, and all the image, the video, all of those technology that have been developing over years. Then we have much more time. We have much more data now to be able to analyze and leverage on those artificial intelligence technology. So before being a CDO of a bank, right, I used to work in insurance, a bit of background about myself, but I started my whole career in automotive, right? And I think automotive is a very good industry because, AI is totally disrupting the way that automotive industry is working. There is a roadmap regarding automatization of the vehicle. You probably have heard of all the self-driving car, the Google car, all the experiments that are being done in US, in Singapore, in China, and other parts of the world, right? And so this is pretty much the technological roadmap that the industry have been working for actually quite some times, right? So you have since 2015, and you can see it in your car today, right? You have some automation that are already happening, right? Whether it's to help you to park your car, or to help you to actually regulate your speed limit on the highway. All of those technology are already today available in the car. But as we are growing over time, right, the software is actually taking more and more importance in the connected car environment. We're reaching a level where level 3. So this is the 5 level of automation of a car today. Level 3 is the autopilot that you can find in the Tesla car already, right? So it's already existing. It's already available in some of the premium car, and it's only gonna get more automated over time. Technically, we say that by 2035, 2040, the technology should be ready because the AI needs to be trained and it needs time and scenario to be trained. Now the question is, will the legislation be ready? And this is one of the things that regulator, car manufacturer, insurance company are actually working on, because it's a different type of risk, right? It's mostly cyber risk, and I will explain this a little later. My point here is that if you look at traditional car vs self-driving car tomorrow, there are some studies that have been done that can, in average, we say that an autonomous car will replace about 9 to 10 traditional car, right? Here in that study that was done by Berkeley University at least 5 years ago, right? So actually they're saying that one car could replace 18 traditional car, right? So I think it's a bit optimistic, but still, imagine the whole word, or even the whole car manufacturing industry today, right? Which is relying, it's an industry that is based on volume, right? And so if you have your volume that is dropping down by 10 times, then your business will collapse, right? And this is the transformation that is going through that industry. There's of course a lot of question about social impacts, right? Today, if you take a country like China or like France that are manufacturing cars, you have about 12% of the total population that is actually relying on the job that is linked to the automotive industry of traditional car today, whether it's selling car, whether it's maintaining them, whether it's producing them. You have the car manufacturer, but you have all the supply chain as well, right? That will be impacted. If the car manufacturer produce 10 times less car, then the supplier will produce 10 times less components, and the vendor will sell 10 times less car, right? So how sustainable is that? And it's impacting also the insurance industry, right? All the risks are calculated connected on a pool of car and driver. So all of this need to be reinvented for the autonomous car to actually, come alive. And it will, because it does make sense, right? This is how the technology are advancing. But the question is, how do we adapt our business model? So this is one good example of how AI is actually disrupting a whole industry and a whole, economy at the end of the day. So yeah, in that example, just to explain a bit the slides, right? They were taking the assumption on a US based family that usually have 2 cars, right? Let's say that the husband, to be a bit to use stereotype, is going to work and then is coming back home, and then his wife is taking care of the kids, bringing them back to school, going to social event. Today they need 2 cars to do that, right? Tomorrow is automation, right? If they actually own the car, right? It's if an autonomous car is owned by the family, they would only need 1 car, right? The car can bring the husband to work, get back home, and then take care of the wife and the children and all the needs of the family, right? If to that you add some sharing model, which is already the thing, the type of model that are existing with all of the private hire platforms, such as Uber and Grab, then, you could reduce the number of cars from actually 9 to 1, right? And then if after you do some pooling, which means that you could grab someone on the way as well, right? So you try to optimize the people that are sitting in the car, not only getting 1 person, then you could replace it by 18 traditional car would be replaced by 1 autonomous car. It's quite optimistic, but this is to show you actually the scale of the disruption for one single industry of how AI works. Coming back to the financial industry, right, and linking that to the car example, right? Insurer have been trying to see how can I actually use and leverage all of those data that are today coming from a connected car. So as you know, now the car are connected. They are what we call an Internet of Thing, an IT, a connected object that are emitting data. And so the insurer were actually trying to look at how can I leverage on those connected car data to do a better pricing of my risk, right? When it comes to accident, which are highly linked with the driver behavior. Actually, why autonomous car is, it's much safer than traditional car, because more than 84% of the accidents are due to human error, right? Someone that is driving drunk on the road, or any other type of inattention from the driver. So they were looking actually at how can I actually price my risk based on the driver behavior. So they are collecting mainly 4 a type of data: your speed, the kilometer, as well as the cornering and harsh braking, right? In order to be able to derive a score and adapt your insurance pricing linked to that, to your driving behavior. Those type of model are mainly found in UK, for example, where the insurance price is so high that, like young driver, for example, cannot afford it. So yeah, some market have developed telematic offering since it's already quite a long time to be able to better manage their risk. That's one of the way where actually you can see how data could improve your forecasting of the risk. So as I was mentioning, when I was starting my presentation, right? I mean, financial industry and whether it's insurer, whether it's bank, whether investment banking, I've always traditionally worked with data, right? Risk people have been, developing models to be able to look at your exposure. Similarly, on the insurance industry, actuaries have been developing models to try to price actually the risk. What has changed is actually the type of data and the volume of data that has been generated. We're saying that every 2 years we are creating 90% more of data, right? So it's only exponential, right? And with the arrival of the 5G, every object will be connected. You have even more, data. You have also the notion of real-time data, and so this has kind of changed the way that we are modeling our risk. So this is actually why now we have the emergence of machine learning and algorithmic modeling, right, that are actually entering the financial services industry. Because, we can't only rely, we have so much data available, we can't only rely on past aggregated structured data to be able to price our risk or trying to predict the future, because this is what artificial intelligence is about as well, using the data from the past to try to predict the future, or using real-time data for that matter to try to better price the risk, right? So, with the amount of data that is now available, the different type of data that are now available, then, the job of a data scientist has actually emerged over the past few years. A data scientist, has usually like three skills, right? It's a statistician first, so very similar to the people that are developing a risk model in bank or insurance world, for example. They have business knowledge, but they also have good programming and IT software background knowledge, right? I think that's kind of the main difference between if you take an actuary and the data scientist, right? The skill set are similar, but the knowledge about technology, the different type of data, the different type of database, and as well as how do I leverage libraries in data science, right, is different from the traditional modeling of people in risk in bank and insurance. One of the examples where you can actually look at unstructured data, right? So structured data are all the data that are what we call in tabular format, right? So whether it's Excel, but mainly in database. Today you have what we call relational database, where we have actually, big table of data that are recorded by an IT system. That's how a database work. And traditionally we were mainly using either metrics that are coming from aggregated data, but very few of the digital data that are today captured by the social media, by Google, on the news, the sentiment analysis that can be provided as well by social media platform. And this is an example of a country, of an insurer looking at country risk monitoring, right? Leveraging on actually all of the unstructured data that are today available on the web, right? And those are much more available. They are much more real time. They can help you to actually predict much more accurately. Let's take the example, a geopolitical example of Russia and Ukraine today, right? You can actually predict on real time, monitoring social media and news, what is the sentiment of the country, and then how would that impact actually your credit risk scoring. Another quite common example in the financial services industry, and this is usually one of the main one that people start with compared to other industry where they would more maybe use like a cross-selling predictive model. Fraud has always been a big topic, right, in the financial industry. So we're using some kind of clustering methodology. Whether it's in the insurance, it can be claims, in the banking industry, it can be the transaction. You're trying to kind of group the anomaly, right? So it's those are models, clustering, unsupervised clustering machine learning model that will help you to actually create cluster to detect anomaly in your transaction or in your claims, right? Whether it's the amount, whether it's where it comes from, and all of this can actually help you to be more efficient in your fraud monitoring activity or your AML activity, for example, right, in the banking context. One of the other type of model that do exist today, and that is also largely used not only by financial sector but everyone today, it's what we call natural language processing. So what an NLP in short does is that it looks at unstructured data. So unstructured data are all the information that you can have in PDF, in emails, social media. I mean, all the content that you have on the internet is pretty much everything that is not in the table format already classified, and try to extract the information, classify it so it can be understandable, and then it can help you to understand, various topics. So that's what we call text analytics. You have a lot of technology that are doing that already, but pretty much you can use all of this to extract information on real time from email, for example, to predict what is the feeling of a customer, right? Out of all of the emails that your organization is receiving, you're a CEO and you want to know which of the customer I need to actually focus on, because I don't know, they might complain complaint to the regulator, or, many other use cases. You can do that on your employee as well. Well, this is to be able to get the feeling of what is your employee, sentiment toward the organization. So you have many techniques today that are actually allowing you to, focus on all of the keywords or sentiment. We call this sentiment analysis, to be able to predict the need of the customer in quasi real time, and then later on, to identify within your mass of customer which are the one that you need to actually take care of. So this is one of the examples that I was just mentioning, customer satisfaction. This is one of the product that I've delivered in my past organization with the support of Amazon Web Service, AWS, so the cloud provider. This is the different type of step, right, that goes into creating a machine learning model. It's very generic, but it's to show you that, there is nothing magic, right? It needs work. It needs, you need to train the model. Then after you need to visualize. And of course, data alone cannot do anything, right? Once you have the insight, what is the action that you're taking? It's usually where a lot of data science projects fail, is that you can predict something, but what do you do about this information, right? Like this is where AI will not help you, right? Sometimes we need to have a human acting upon it. So why is becoming a data-driven organization so hard, right? I mean, a lot of organizations have created CDO role. This is a role that is actually becoming quite mainstream in a lot of organizations. What does that mean, and how do we become a data-driven organization? When you look at a data strategy, you need to encompass a lot of pillar, I would say. So taking again the example of the car, it's not coming from me, this one, to be honest. It's coming from one of the institute of data that is running some policy and assessment. But you have different things when you think about data. Data is everywhere today in your organization, whether they are structured in your database or whether they are unstructured in your email, in your PDF, even in your paper, right? Paper that is written is also a type of data. What are the real assets in my organization, right? How do I treat data? We're saying that data is the new oil, right? And the same thing as the oil, right? The data need to be extracted, it needs to be refined, it needs to be, you can have like crude oil, but what do we do with it, right? You have different type of finished product that are actually leveraging on crude oil, whether you are doing whatever, clothes, plastic bottle, using it in your car, right? I mean, it can have many type of usage. It's the same thing with data, if I want to take an analogy, right? So first of all, you need to look at, okay, what do I need to do with my organization? And then after, of course, there's always the issue of quality, right? I mean, we always say that in the software word, garbage in, garbage out. If your data are inputted wrongly into your system, right, then of course the insight will be biased, right? Because the data quality, the data entry was not done properly. So you have some metric to actually follow on that. Same as for oil, actually, right? Like you have also some standard on the gasoline that you can put in a car, and you have some requirement in terms of quality for the car to actually use it. So similar with data, you need to have good data quality, and this takes a lot of time, processes, policy, and then the involvement of everyone in the organization. Data is an asset, and same as electricity, everybody is using it in a different form, and everybody needs to be aware of the impact of what they are doing in terms of data entry, for example, that it can has later on any type of reporting, BCBS 239 regulation being one of the big topic on data quality, or being able to actually impact an AI model in the future if the data are not collected correctly. So for that, you need to implement an overall governance strategy, right? Like, how do I govern my data? Who are my data owner, right? Who are the ones that are responsible to look after the data quality? How do I improve that over time, right? And this is a BAU activity, right? It's not a one-time effort. With that, you have also the complexity of the various data protection and data privacy regulation. More and more countries being also concerned with the localization of their data. You have some countries such as China, Indonesia. I mean, I'm more focused on APAC, that don't want the data to be located in another country, right? Because they think that data is an asset and they want to keep it in their country, right? And so how do you actually, apply with all of those, comply with all of those regulation? You have also the data protection activity when it comes to, having the consent of the customer, right, in order to be able to use the data. Everybody have heard of the, PDP, GDPR law in Europe. So those are growing concern, right? And also that where technology can actually help, but, you need to take that into account for sure. Then after, the engine, right? This is where data is crossing a lot the IT world, right? What are the right platform? And it's different from software delivery, right? Data analytic and AI, you have the same type of skill set, but it's very different in terms of mindset and what are you trying to do with it. It requires flexibility. You need to have an API-based platform. I would recommend if you don't have anything to start to go on cloud, right? There's no need to actually try to develop something by yourself where, all of the big cloud provider, whether it's Google, whether it's Amazon, whether it's Microsoft, have already developed those solutions for you. But this one is the core engine, right? Like you can't run if you don't get a proper data stack, as we call it, right? And then finally, even much more important than the engine is the people, right? If you don't have no one who knows how to drive your car, you won't go far. You can have put all of that in place, but if you don't actually train the people on how to properly use data, and there is a big trend, and that's what we're actually doing in Bank of Singapore, it's called data democratization, right? How do I allow everyone in my organization to access data? So those are the different type of activity, and I only have like 4 minutes remaining, so I'm going to go fast on the last few slides. But this is all of the type of activity that needs to be done as proper data management, and this is a huge work, right? This is not a half people job, and you need to take that into consideration. Those are the foundation for you to be able to actually leverage on your data and to develop an AI model. You have a lot of, policy, again, governance framework, data quality. Again, I will not repeat enough that, garbage in, garbage out. Data quality is one of the big topic. How do I do to monitor, to improve, to remediate my data when it's the right time? The risk on the data protection. Documented what we call the metadata, right? A lot of the data that are in your systems today have no definition. No one knows what they mean, right? What does that field means, right? If you want to be able to use them, to interpret them, to use them in a model, you need to be able to define them first. So a lot of time that we're spending on actually defining what those data means, right? And then, the overall data access topic, right? Security and that people are actually quite aware of. So again, data culture, same thing as the car example. If you don't teach people how to drive, you will not be able to go far. And it's not only one data scientist that can drive a data-driven organization. It's everyone need to learn how to drive a car, right? Let me put it that way, right? So of course you got the technology, platform, tech stack, whatever you want, same as the car. But if no one knows how to drive, you won't go far as an organization. So for me, it's one of the most important topics, right? Everyone is looking for something different in the data. Everyone needs their own view of their data to be able to generate insight and take decision upon that. This is what a data-driven organization means, right? So this is a type of tool, but if people don't know how to use the tool, same as a car, if you don't know how to use a car, you will not be able to drive far, right? So empowering the people, what we have done and what I've done in my past two organizations is create this model of hub and spoke. So I run what we call the data hub, right? I look at the platform strategy, I look at the governance, I look at the, I'm the responsible for data protection, but my most focus is on the people, right? So I can give an example. Today in Bank of Singapore, we are a 2,000 people bank, and we have 206 people that are onboarded on the platform and know how to code to be able to extract and interpret data. It's not happening, overnight. It takes time. You need to hold their hand. And so for this, we have created small analytical team in each of the department, right? That's how you start your data democratization journey. The first thing that I do usually is to try to look at, okay, what is actually the level of maturity from each of the department, right? And each of the team, right? I need to find my data champion in order to drive my data democratization agenda. I need to make everyone understand that, without having the right analytical skill set, right, of interpreting data, which requires statistical skill set as well as programming skill set, then, you will not be able to be a data-driven organization. You need as well for the data consumer to be able to interpret, right? What does the chart means, right? For the decision maker, they need to be data literate, as we say, right? They look at the chart and they need to understand what is the next action as a CEO that I actually need to take looking at that chart. So, even the upper management needs to actually upskill to be able to leverage on the data and insight. So this is an example of, some of the upskilling organization. Again, it takes time, but, investing on the people for me is one of the most important aspects. After investing in the right platform, really the people side is quite important. And I think that's the end of my presentation. So I'll get a question here on the Q&A, and feel free to, put any question that you might have in the chat. How do you see the role of data quality in financial markets? Is it sufficient to support sophisticated ML application in debt capital market on a wider scale? I mean, this question, like data quality is also, you have different things when you talk about data quality, right? You have first, how do you source your data, right? So what is actually the format? And then after, you have question of standard and definition, right? We realize that, a lot of people, and that's what BCBS 239 regulation is actually bringing in the financial industry in terms of risk reporting, right? That some of the data that we are using today, it's a question of definition. We are actually merging two different type of data, and then we come with a metric, right? I don't know, like interest rate to be one, right? You can look in a bank, you have, I don't know, 150 way of calculating interest rate, right? Which shouldn't be. You should have one definition and one way of actually being able to define that data. So it often comes with, having a standardization of the definition within the industry. So on the capital market side, I might not be the best one to answer, but this is usually at industry-wide level. This is something that a lot of regulators are actually working on. We have big initiative here in Singapore, for example, with MAS, our regulator, to look at standardization of data and definition that are collected. One of the use case being also sustainability. Like all the ESG rating for all the financial instrument, right? The way that it's calculated today, I mean, the way that the definition is done and it's reported, you might have heard about greenwashing. The Singaporean government and regulator have actually launched an initiative to be able to, ensure that they have accurate way of sourcing the data and the right definition, so the overall industry can use, common standard, talking about the same thing. So I think on some of the topic, it needs to be an industry effort, and that definitely takes time. But when you have regulators that are actually, behind the transformation of the industry, it definitely tremendously help. But, data is not a destination, it's a journey. It's, things that will fall down eventually over time. But definitely you can do machine learning on any type of data, whether they are structured or unstructured.
Good morning, everyone. I think it is now the turn for the panel, and I have to say, Celine, thank you very much for a fascinating presentation. I think many of what you have been speaking about is resonating very much with all of us. Particular, I'm pretty sure, and I love the question at the very end. You don't need to be a capital market specialist, but all your answers, I think, are very transferable to actually the capital markets in a broader sense. Interesting to see how you walked us through the journey that data is not necessarily something new, but the type and the volume that we have been starting to collect over the many years is actually what makes a big difference from here on. And I like as well very much the fact that you mentioned that it's about the people, that you need to bring the people along the journey, that you need a regulator that is behind this, and to the point of the question from the audience, and thank you very much for that. Standards are required, and so thank you very much, Celine, for a fascinating presentation.
Thank you very much for inviting me. Have a nice day, everyone.
Thank you. Well, thank you very much, everyone, for hanging on. Hopefully, the presentation by Celine has been fascinating already in its own merit, and hopefully this panel focusing on leveraging the latest fintech developments in capital markets is a continuation of what we just heard from Celine. I think the title in itself already is somewhat saying that there is a lot of work ahead of us as well. To the same extent of Celine's job to get an entire industry and organization more or less fit for purpose when it should be data driven. that I'm pretty sure holds very much true for the broader capital markets as well. And for that, I have a fantastic panel of experts with me this morning to discuss the leveraging latest fintech development in capital markets. And maybe with that, ladies first, it would be great if Carmela, if you like to introduce yourself, and then we go through the round. And I think it's Olivier, Patrick, and Sam. So Carmela, over to you.
Hello everybody. Thank you for inviting me today. So my name is Carmela Holtgrieve. I'm head of digital office at Deutsche Bundesbank, and we try to get a holistic view on digitization trends on the one hand, how they affect central banking, but also what we as a central bank need to do to best support the market to use and leverage the opportunities of new technologies. Thank you.
Perfect. Should we move on to Olivier?
Hi, everybody. Thanks for having me today. It's obviously a pleasure to be with you guys. My name is Olivier Chapiteau. I work in the capital market department of the European Investment Bank. I'm part of a team that's focused on a new product on special transactions. And as part of our mandate, we've been given quite a bit of resources and time over the last years to focus on blockchain technologies. And that's how we onboarded on a journey that led us to issuing our first blockchain bond actually almost a year ago now. So pleasure to be with you guys.
Thanks, Olivier. It will be fascinating to hear later on a little bit about the lessons learned from your exercise 1 year ago and what has happened since then. Over to you, Patrick.
Hi, thanks, Armin, and thanks to the ICMA for inviting me to be with you today. Patrick Armstrong with the Financial Stability Board, where I am responsible for the Financial Innovation Network and for financial innovation in general. Thank you.
Perfect, Patrick. And to the point of Celine saying we need the regulator on board, we have the regulator on board, which is fantastic this morning. And we do have as well, right where Celine is in Singapore, back to Singapore, because there we have Sam. Sam, over to you. I hope we have Sam.
Oh, my apologies. I was muted. But hello, everyone. Thank you, Armin, and good morning or afternoon to all of you. My name is Sam Ahmed. I am the Group COO for Treasury and Markets at DBS out of Singapore. Pleasure to be here.
Perfect, Sam. Thank you very much. And I think it comes for a reason that we have two colleagues today out of Singapore, because it seems like you have a regulator there as well who's pushing the boundaries, and I'm pretty sure we're going to hear about that a little bit later. My name is Armin Peter. I'm the global head of Debt Syndicate and the head of sustainable banking here at UBS. At the same point in time, I'm the chair of the Fintech Advisory Committee of ICMA, and it is in that merit that we're going to run this panel today on the topic of leveraging the latest fintech developments in debt capital markets. I want to start the panel in a way by reflecting on the first quarter, which by all means has been very, very challenging, not least because of all the horrible events in the Ukraine. And unfortunately, markets don't stop, and so does not stop the development around technological developments. And if I turn to Patrick, I must say the FSB has been very, very busy at the start of the year. In February alone, they came out with a paper on crypto and the assessment of risk to the financial stability. And then in March, Patrick, you guys followed up with a paper on fintech and market structure during the pandemic. So two, I would say, really milestones and somewhat very much telling and ideal for us to start this panel on reflecting actually of what has happened and what can be leveraged and should be leveraged going forward. So Patrick, clear question, what has happened? Maybe a brief summary of what is in these papers and what's on your mind when you are looking at the panel title about leveraging of the latest fintech development.
Okay, thanks very much, Armin, and excellent question. It has been busy, both from a macroeconomic standpoint with the knock-on effects of the pandemic and then the war in Ukraine, and importantly for our discussion today, the technological and market structure tectonic shifts in response to these and earlier events. As you mentioned, the market structure in the COVID-19 pandemic follows on a number of other market structure reports that we've published over the past few years, which look at the interaction between incumbents, big techs, and fintechs. And what this report reveals, or what our work reveals, is that the trends that we saw in place earlier in terms of big tech entering the field of finance, fintechs serving more in a partnership fashion, and incumbents trying to respond to the presence of these new entrants only accelerated during the pandemic. With the lockdowns, the increased move to digitalization, the increased demand for digitalization, all of those trends increased. And the report discusses the acceleration of digitalization in financial services and tries to answer the question as to whether the changes we saw during the pandemic are structural, or will they revert back to some sort of normalized pre-pandemic level. The report looks at the market share that big techs and fintechs have picked up during the pandemic, whether it be in payments, credit, insurance, investment. Data is difficult to exactly get access to, but from what we can tell, using some certain proxy data, that indeed big techs have very much accelerated their presence into financial services. And however, we talk to the incumbents as well, and the incumbents see the increased competition in core banking activities. But some stakeholders believe that big techs have little appetite for certain low margin banking activities that come with attendant costs in terms of capital requirements, risk management, compliance, and regulatory oversight. And instead, what many of these big techs may be doing is looking to partner with certain incumbents in order to provide certain services while leaving the actual banking activity to the regulated institutions themselves. In terms of the pandemic, though, we also saw the acceleration of so-called challenger banks, those without bricks and mortar, who benefited from certain of the government payment schemes during the pandemic. Some went from loan books that were negligible to having sizable loan books today. And what I would say is that these trends are not homogeneous across all jurisdictions. It really depends upon the jurisdiction, what was in place before in terms of incumbents, and the degree to which big techs are easily able to move into certain environments that don't have the constraints in terms of regulatory barriers. The second issue, just to pick up on, is crypto assets. Yes, in February, we published a report that examined developments and vulnerabilities associated with crypto assets, both unbacked cryptos, i.e. Bitcoin, stable coins, and DeFi. And while we divided the report into these three segments, they're closely interrelated in a complex and constantly evolving ecosystem and need to be considered holistically when assessing the related financial stability risk, which is, of course, the most concerning thing for our institution. The report notes, though, the extent and nature of the crypto asset varies, again, somewhat across jurisdictions. However, we believe that financial stability risks could, if the right forces are in place, escalate, and we need to take preemptive action. And I believe we will do. To your third point, I think my introductory time is up. Would love to get into the discussion as to why it's imperative for financial institutions such as those gathered here today really need to make the transition to digitalization. Thanks, Armin.
No, Patrick, that's fantastic. I think you highlighted a couple of very important points. Amongst one, which I pick up, not only the regional differences and speed, that certain continents one can say are moving, and they're not moving all in the same speed. I'm picking up on the other point, which you said, when you're looking at the paper around, what happens through the pandemic and this acceleration of certain trends. Is it temporary? Is it lasting? Is it structural? What is it? That probably is quite nice, actually, to pass over to Olivier, who already mentioned at his introduction, of his experience of launching a digital bond, tokenized bond, actually 1 year ago. Olivier, maybe if you could share a little bit your lessons learned from that exercise and 1 year on of what's in your mind, yeah. Particularly thinking about this point about, is it temporary? Is it lasting? Is it structural? That would be quite interesting, I think, for the audience.
Okay, so starting with the first project and the lessons learned, I think like when we started to work with our dealer group to structure the transaction, and we were working with Goldman Sachs, Societe Generale, and Santander, the first core idea was to try to bring on the trade as many features as possible that we would have had in normal off-chain bonds. So we wanted the transaction to be multi-dealer led. We wanted to have non-affiliated investors. We wanted to have a certain size, also relevant maturity, but we also wanted to sort of experiment and bring on like very specific technical features. Typically, we wanted to try to have both the security moving on chain, but also the cash moving on chain to the extent possible. We wanted to use a public blockchain network, and when we sort of put all these requirements together, we're thinking that we're trying to push a lot on the technology, that we're trying to push a lot on chain. So our first guess was that the project would be very tricky from a technical standpoint. And now what we've actually witnessed going through the project is that at the end of the day, the blockchain ecosystem is one that's grown already for quite some time in a fairly unregulated environment first. But it means that by now you really have a deep pool of talent that's available to kind of take on and tackle any technical problem you might have. So at the end of the day, there was a lot of hard work on the technical side, but things went relatively smoothly. On the other hand, and maybe something we could have anticipated a bit more, is the fact that blockchain technologies are still new in the scope of like a very regulated environment like debt capital markets. So we faced a lot more of like legal points that we need to assess in details to issue in good condition than we were initially expected. So we ended up with that reverse balance where the tech part got much easier than we thought, and the legal/reg part was a bit more difficult than we had thought. And one extra point I would mention is probably the fact that for one thing that could have been even trickier is like the ability to move cash on chain, but we were very lucky to strike a partnership very early on with the French Central Bank that was extremely collaborative and opened us to have access to a temporary representation of CDBDC. So that was extremely useful. So I think all in all, what that means that for me, the tech will keep evolving, obviously, but the way we're going to shape the legal regulatory frameworks and the way we're going to collaborate with authorities as market participants is going to be crucial in defining how things are going to evolve moving forward.
Thanks, Olivier. Quite interesting again. It just resonates with what Celine earlier on was saying about, AI was there already for quite some time. It just has evolved, yeah. And at the same point, you are one of the key lessons learned was as well. The blockchain and DLT has been there for quite some time. The technology is already there. Actually, the talent is there. It just hasn't been necessarily augmented, yeah, with the conventional world as we know it. And you made the life experience. You made another very good point, and I'm pretty sure we're going to talk about this. Is about tech on the one side, but legal framework on the other side. Again, it needs to go in lockstep. If that doesn't do, then probably tech is faster than the rest of us, yeah, in a certain way. We heard earlier on about from Patrick as well that different regions are moving on a different speed. Yeah, and again, quite happy that we have Sam on board, and maybe a good point as well, just to pass on to Sam to understand, what's different maybe in Asia and what DBS you guys are actually doing, just to compare that to the lessons learned of what we just heard from Olivier.
Thanks, Armin. So yeah, I guess now we bring the conversation back to Asia, and given that this is a fixed income discussion, maybe talking about Asia in the context of fixed income and why fixed income markets have never really taken off. Well, first, as you guys know, it's a fragmented region, right? Fragmented in terms of government policy, banking regulations, cross-border regulations, even overall practices and processes that banks and financial institutions deploy is fragmented, right? So from a fixed income perspective, the ideal scenario would have been an issuance done in Indonesia gets bought by investors in Taiwan. You would expect that, right? In the real world, unfortunately, that didn't happen. Not only because of regulatory issues, and not only because of uh, market risks associated with currency and interest rate differentials, but it was just overall cross-border risk, and there were so many differences cross borders that to streamline that fixed income issuance across the region, no one, I would say, managed to do it successfully. So as we came towards 2015, 2016, 2017, there was great hope in the market that blockchain is coming, and somehow blockchain will integrate the Asian bond markets, and finally we'll see something totally streamlined. I think the issue was that the technology actually can achieve a seamless issuance to investor process one day. But the problem what we're having is that not all the locations are adopting blockchain technology and crypto exchanges in a consistent manner. There's still fragmentation there. And even if you think that, the cross-border transfer of a bond from a local custodian to a global custodian, back to a local custodian, or payments to various corresponding banks can all be ironed out by digitalization, the problem is we're not at a stage where all the institutions and governments are talking to each other and saying, let's build this platform together. Maybe in Europe, it's easier because you already have T2S and various other infrastructure and common standards. But in Asia, unfortunately, we are not seeing a consistent development of blockchain or crypto platforms. So this brings us to Singapore, right? So I guess in Singapore, the regulator has been cautiously optimistic, and we can talk about that later on. But obviously, there's been digital license granted, and they've also allowed banks like us to tokenize some of our own native issuances and also to launch our crypto exchange. So digital exchange was launched in 2021 for 4 of the coins, Bitcoin, Ether, Ripple, Bitcoin Cash. Concurrently, what we did, and I think what was highly encouraged by the regulators, was to build our own digital custody. And the reasons why was we had to deal with AML and KYC issues. We had to ensure that we have a cold storage to prevent hacking. We had to ensure that every coin that was transferred in was fully screened for everything from AML, but also terrorist financing. So those are the 2 things we did. And currently, what we're doing now is we're trying to issue our own fixed income bonds onto the crypto exchange where there's already organic liquidity, in the hope that some of this liquidity would get sort of spill over and create some economies of scale, right? So that's where we are at the moment. I mean, it's still a long journey. We're just on the edge of starting the journey, but it is exciting.
Excellent. Thank you very much. I mean, it does give a very good overview. In particular, I think the word I'm taking here away is fragmentation. Yeah, one of those biggest concerns where, honestly, we are acting in the global capital markets environment where, frankly speaking, the glass, is not broken. Yeah, so making consciously aware that whatever we're going to build and we believe is better, is actually better, by many ways. Thanks for that, Sam. Carmela, we had a pre-discussion amongst us, as everyone would expect, and one of the key points that somewhat came across is, there are, different things can be done in different ways, right? But to more or less achieve the same thing, yeah. So there are different ways to get to the same point, and I think in that regard, the Bundesbank probably made the one another example. And I think I wanted to ask you, with all this let's say, one-off testing, playing in the sandbox. Yeah. The question is, okay, are we at the point actually to mature beyond? Yeah. To the same point what Sam was saying, right? One tries to increase the liquidity overall, yeah, to make it a real infrastructure, a new infrastructure. So, Camilla, maybe over to you. Just as a question, where do you think we are? Are there different ways? What's the right way? What's your experience?
So thank you, Pete. There are for sure different ways. But to begin with, Bundesbank is traditionally open to, let's say, technological progress in general in digitization, because it allows and offers a lot of opportunities to make business models in the financial sector more sustainable and the financial sector as a whole more stable. However, the flip side, and we already got a glimpse of it when Olivier explained about his experimentation and Sam explained how it's going on in Singapore and the Asian region, is we have a growing complexity, which we somehow need to address. And we also see an increasing division of labor in the banking business, which also increase the potentials for risks. And from a central bank's perspective, it is not about mitigating risks as they arise. It is particularly important to get a holistic view and a really broad understanding of the chances and the risks. So it wouldn't actually fit to a central bank to, let's say, try a quick shot from the hip, because it could lead to major drawbacks. And it could, especially in the case of such significant technological changes as CBDC or blockchain in general. So for these reasons, all decisions we make and everything we try to bring into broad implementation needs to be carefully considered and properly backed up. So it should not be underestimated how swiftly a young market can break away if, let's say, a level of confidence is shaken, or trust, which is like our major currency, trust. And we need, therefore, a thought out framework that is ideally as global as possible. So beyond this, it is that digitization and new technologies in experimentation, and ideally on a later stage, and this later stage should not be too late, should make not just, let's say, it's not just about making money or it's just about the financial sector, but it has a much wider impact. It's kind of making the world a better place. So yeah, that's it from my now.
No, and Camilla, I take you up on that one point. You need a global framework. Do you? And we've done a lot of testing. We wrote a lot of white papers. Yeah, and Patrick just mentioned two, I think, very crucial ones. For example, governments are coming forward to establish regulation. Do you think we are on a good track for a global framework? Or do you still think people are running in different directions? I'm comparing a little bit with the sustainability world, right? Where I have to say, I don't have not the concern. I think everyone pulls in the same direction. Everyone has a common denominator, which is decarbonization in the earth. Yeah. Do we have the same actually in the topic that we are discussing? Yeah, fintech and data and so on. What's your view?
So my view is that we see an increased level of collaboration. And I think this is like the first and really needed step to get a holistic view and a holistic understanding and a framework. Because if we do not talk and work with each other and get a better understanding and learn, we will not be able to, let's say, build something like a framework in the best possible way. So I would say, yes, we see an increased number of collaboration. We also see an increased number of institutionalized collaboration. For example, the BIS set up the BIS Innovation Network and the BIS Innovation Hubs worldwide, which work on different topics that are effective. We are talking and discussing today. So from a central bank perspective, I would say, yes, we are working on a framework and we are getting closer to this.
That's fantastic. I think it's a great message. And I have to say, this institutionalized collaboration, usually investment banks are all a little bit against themselves. Yeah. But when it comes down to an infrastructure implementation, I have to say, to the point of Olivier, he worked with 3 banks together and so on. I think there, we all come together. Olivier, is it fair to say that there is a greater level of collaboration felt?
No, I do think so. And to Carmela's point, I do agree that, for example, as an issuer, after following our first project, we obviously brainstorming on new potential ideas in the same field. And overall, our collaboration with regulatory bodies, central banks overall is extremely good. And I think what you said is crucial. Let's say as a market participant, you always want things to go as fast as possible. But we also, I think, as an ecosystem, we need to have the patience to acknowledge that we evolve in a very regulated environment, and we'll all benefit in the long run of a healthy, appropriate, and solid framework. So I think at this stage, at least from as an institution, we're very happy with our collaboration with public bodies. And when it comes to the broker dealer industry, so your side of the fence, Armin, I think indeed that's a field where so far we see stronger collaboration between institutions, partly because the development costs are fairly important. So there's maybe some need for mutualization. The question will be whether it will keep going that way, or will we witness some fragmentation at some point that needs then to be recrystallized? Because we're still very in the discovery process of what can be done with those technologies. Like you said, we're still all running experimentations at the end of the day. Nobody's mass scaling, putting things in production. So probably there will be a moment when people start to kind of try to build sub ecosystems. Will we be able to live with them? And then we will need to create a lot of interoperability. Will there be some recrystallization? That's to be seen, I think.
Yeah, it's definitely. Before I move on to Patrick, I would certainly say that's exactly how we see it at ICMA. And we want to bring these stakeholders all together at the table and work to what you heard from Brian on common standards, and you heard it from Celine as well. No good data organization without actually data standards and a definition of such. Patrick, maybe quickly over to you. Coming together, just maybe a word of reconfirmation or denial, one of both. When it comes down, do you think we are on a global path? On coming together, that the stakeholders are coming together. And then one key question as well, in our preparation call, we were actually looking at what are the real world risks adopting the new technologies. And you jumped in and you were saying, I would rephrase it and just simply say, what are the real world risks not adopting? And I want to take you up on that, because I think it is so telling as well for the culture and the attitude, and to what Carmela was saying beforehand as well. It's not all about risk, right? There are huge opportunities, but there are deliverables to make sure that we find the right balance. So maybe Patrick, over to you. You're on mute.
Sorry. Thanks, Armin. So on data, last year we published a report on the use of regulatory technologies by market participants, such as the folks gathered here today, as well as how supervisors could use technology. And certainly one of the key themes that came out of the report is how one goes about the process of gathering, cleaning, managing, and analyzing the data to make it useful. It's a tremendously challenging process, as we have both structured data, traditional regulated types of data, as well as unstructured data, which both market participants could use for RegTech and supervisors could use as well. data standards are uneven. And we call that out in the report. And we definitely need to move towards a greater degree of data standards in order to make that data interoperable among both market participants and supervisors, so that it makes the challenge of trying to comply with all these regulations that have come about both more efficient and more facile for market participants and for the supervisors themselves. So it's a key issue. Thanks for bringing up the point about adopting new technologies, the second point that you just brought up. And I would say if we were 5 years ago, we'd still be, we both as supervisors, you as market participants, would be still saying, well, should I be using the cloud? How safe is it? Is it really impervious to cyber attacks? Similarly, with the use of APIs, how can I trust them? You know, who are these new entrants, these fintech firms that are providing them? I think the pandemic has brought about a holistic embrace of some of these tools that have dismissed many of the concerns because they've proven to be largely sound and safe venues to make organizations more efficient and more digitalized. And so to your point, I would say the real challenge is for institutions such as those gathered here today is that you've got digital natives and you've got digital laggards. And I would suggest that unless those digital laggards embrace the role of the digital pioneers, the digital natives, and use some of these digitalized tools to improve the business process, improve the client relationship process, they're going to be left behind. And because there's a whole new generation that is emerging that expects to be able to have their services met, like their social media is met, like their commerce experience is met. They want the finance experience to be just as fluent. And if it's not, they'll go elsewhere. We see it in the data. Thank you.
Very much so. I mean, this is actually fascinating, and makes it somewhat easy again to bring it back to what Celine was talking about in terms of you were saying, you know, native versus laggards. You know, she brought a slide up for everyone probably to go back, where she tried to set a baseline in, you know, how the organization looks. Yeah, where are the weak spots, to then go in there and help them, because she made the point about culture and people. She's, you know, beside of analyzing all the data and making sure that you follow standards and you make them structured, for her it was very much a point she got away around people and culture. Sam, what you just heard from Patrick, yeah, what Celine was talking just from across the road, more or less, yeah, how does that resonate with you? And you know what you've gone through with all the multiple test cases, from bonds to crypto exchange and derivatives and so on. I would be interested to hear that.
Sure. I mean, just before I say that, let me just make a comment on what Carmela said about collaboration, because it's so important to us right now where we are. Because you see, it's right now the way that financial markets are heading. It's all about building ecosystems. And it's not about competing against each other, because the pie is big enough for everyone. You see, Asia is growing, and there's tremendous wealth in pockets in Asia. The question is, how do we take the excess capital that's in some of the pockets and divert it efficiently to where capital is needed? And that's where banks can't do it alone. We need we need ecosystems, platforms. And if we want really for fixed income issuance to supersede bank lending, because Asia so far has been funded with bank lending, but if we can shift it towards fixed income issuances, bond issuances, then we need to collaborate. Okay, so that I just want to make a comment there, because I agree with Carmela and with Olivier. So to your second question about innovation, right, and what we need. So I think, you know, Piyush Gupta, the CEO of DBS, keeps stressing on company culture, and the fact that innovation should not be top down. right? It should be bottoms up, because at the end of the day, those that are innovating, those that are really plugged in, they are the Generation Z. We should encourage them and empower them and give them the right tools to come up with innovation. Just to let you know that a month ago, Piyush invited all the managing directors to a conference, and for the keynote speaker, he invited 2 CEOs who were like 26-year-old, and they were CEOs of one of the biggest gaming companies in Singapore and in Asia. And okay, we were a bit surprised. Didn't expect, 300 MDs to look at a bunch of 26-year-olds on stage wearing jeans and t-shirt and Converse shoes. But it was fascinating what they were saying. They were saying there's tremendous wealth in the form of gaming tokens that are trapped inside these gaming ecosystems. How do you make that fungible in the real world? Or how does it go to a different platform? How is it interoperable? How is the metaverse going to connect us to our own platforms? And who are the intermediaries that play that role, that can convert gaming tokens to cryptocurrencies back to fiat? And I think that Piyush just wanted us to listen with respect. And that is the culture we're trying to build here as well. We want psychological safety so that our junior people, come up with ideas and they're not shut down. And I think that's the type, in this new environment where there's things like NFTs and gaming tokens that we probably don't understand, we need to respect the new generations that understand it and give them the voice to be heard.
I completely agree. I think to the point of what Patrick said as well, if you're not engaging, then you will be left out, right? If the next generation defines, value transfer away from fiat, what can we do, right? We can sit here in our offices and say it was always like this, it was always like this. And outside the world, is moving money around in a complete different way, and then it's more uncontrolled. And I think we had financial crises which were built on, shadow banking and these kind of streams, right? I get it. We have 10 minutes left. Q&A session is something which goes by the Q&A function, so I can encourage everyone to post a question. I can't promise how many we probably can answer in the last 10 minutes, but maybe one just point, since we have been speaking about this a couple of times as well, and Camilla, I mentioned earlier on, there are different ways of achieving the same thing in a certain way, right? And I think with your trigger model, looking in the merits of cash transfer, the merits of bringing cash and digital token or digital assets together, I think it's a merit of a hybrid. And we know as well that any transformation probably needs to go through a hybrid before you really can land in your new world. What do you think can or can't or should or shouldn't automate it? Is there an answer, or is it everything can, but it's a matter of time? How would you feel about it?
So that's quite a difficult question, though. But I would say that there are like different levels. First level is then when it comes to automation and the role of us as central bank, as the regulator, we need to make sure to know exactly where the responsibility of the company or the bank begins and where that of us as a regulator ends. And we must anyhow avoid of, let's say, have a mixed up situation of a supervisor with the management and the operations of an institution. So in this context, let's say AI models or algorithms can somehow prove to be kind of black boxes, and the need for explainable AI and explainable new technology is super important. So when decisions are made by in AI somehow and have a direct impact on us as humans or the risk situation of a bank, then we really want to make sure we understand how the AI makes a decision. So it's a lot about understanding, transparency, and the need to see the concrete use case when it comes to automation and what is possible and what is not possible. So there are a lot of cases where we don't need to put the same, let's say, focus and attention to as chatbots or anything that it runs basically, but let's say on the level of robo-advisory, which has a direct influence, we need to better understand, and we need to better make sure to where goes the automation and where does it need to stop, or where do we need to have a human brain have the interpretation done. And beside that, and that comes back to what Celine said before, any artificial intelligence is just as smart as the data is it fed with. So it is, when it comes to automation, we need to make sure that the data quality and the data relevance is key and is clear and is high quality. And if we have all this made sure and all these barriers set, then let's say we can move forward with the level of automation. Yeah, I think that would be at least a try to answer this question.
Very, very well done, Camilla, because I think that is a difficult question, yeah. And I would say it is very clear, yeah. Not everything is done, not everything is necessarily understood, yeah. To the point of, the first, we played in the sandbox, we've done this, we've proven it, we feel something is possible, everyone has a right stomach feeling in a certain way. Now we just need to bring that all together to the many points and comments we already heard on the panel. So no, well done, and thank you very much. I don't have a question yet on the Q&A. I think that helps us quite nicely as well to move into the final stage of the panel discussion. And that's a little bit of forward-looking, or it's something more about your other remaining barriers. Yeah, what needs to happen next? Yeah, and maybe some of those comments we already heard, but it's always good to hear that at the very end again, to just emphasize of what is needed from here on going forward. And maybe with that, Patrick, do you want to start with providing a comment on that part?
I mean, I think just consistent with what the themes that you've brought out here today is, I think for market participants to remain paranoid. Yeah, big techs, fintechs, digitalized incumbents are acting very quickly, are acting proactively, and one cannot be complacent. It's a fast evolving world, and one needs to be digitally adept to be able to meet the challenges. Thanks, Armin.
Perfect. Thank you very much. Olivier, what comes to your mind when we think about the barriers being left, yeah, and next steps?
On my side, actually, I'm going to bounce back to kick it off on one of Sam's point, like earlier, which I really like, the fact that today you have a lot of new capital that's locked in the metaverse. It's a new kind of capital, and we probably need to find ways to unlock it. And that was making me reflect on the fact that on our side, I mean, as an issuer, a lot of our investors are traditional investors with a lot of capital locked today in legacy / off-chain assets. And for me, a lot of the work on our side to kind of bring its next stage is going to be to encourage these people or give good reasons to these people to move and maybe join the metaverse people who will just be coming in the mainstream online world, to have these offline people also coming there. And for us, I think, given the environment in which we evolve, like it's going to be a matter of like regulation work, but a lot of things are being done. I think we covered that quite a bit already today. And I think we'll have to move away from experimentation to proving ease of use and added value on key use cases. Like I've not been long enough in the industry to say I was there, but talking to the very senior bankers, you're gonna have people who tell you debt primary markets have been functioning the same way pretty much for the last 20, 30 years. And now today we have a technology that's giving us potential for disruption, maybe like a sort of like repositioning of the value chain in the industry. And there are probably hasty ways to do that, but we're gonna need to to kind of like prove that we can do it, so that capital like moves along and comes on chain. And I think that's what we need next.
Perfect. Thank you very much. I will move to Sam first, and then ladies last this time. So Sam, over to you.
Okay, so I will just echo a bit what Patrick and Olivier said about being vigilant, because we are in a landscape right now that is really moving, and we're entering new frontiers in finance, banking, and fintech. And I think that, you know, we are still in a position to be early adopters and early movers. We need to walk the fine balance between embracing this new landscape and also being prudent towards the risks that come. But what we don't want to do is be sitting ducks and be the Nokia of tomorrow. Yeah.
Very, very good. Thank you very much. Camilla, your view, next steps.
So I think a lot of important things were already said by Patrick, Sam, and Olivier. But let's say from a regulation point of view, we have to ask ourselves whether our regulatory framework will remain appropriate for the financial sector of tomorrow, or how we need to let's say, in an agile approach, also work continuously on the framework, and is it still answering all the needs, and is it also taking into account all the risks that needs to be in account, and is it also let's say offering the possibilities to use these new technologies, and especially as we see, let's say, a lot of new market participants and a lot of non-regulated market participants entering a very regulated ecosystem. So yeah.
I love it, and what you say, is a regulatory framework, is still appropriate, or how can it make the transition? Yeah, again, in the sustainability world, you have science-based glide passes. Maybe we need something similar, more or less, for the global regulation of fintechs. I know we have maybe 1 minute before I make a couple of closing remarks. And I take the one out and just put it up into the open, and someone of you need to raise if you have an answer to that. There was the talk about new entrances into the fintech space. What is the most exciting or interesting idea the panel has heard of? Is there something that you guys, what caught your eyes, what you think is something, that we haven't necessarily heard, 1 year ago? I don't know, Sam, is that something up your sleeve where, you can say something?
I'll just be very quick. I think, again, going back to the metaverse, it was really interesting. There are people that are buying properties on the metaverse, and they're not cheap properties. They need a bank to finance it. And there was talk, this is all blue sky. Should we open a branch in the metaverse? How would it work? What would be the regulatory landscape? I thought that was fascinating. I'm not sure if it'll ever eventuate. I'm sure it will at some stage, but how fast we move there, I'm not sure, but I thought it was fascinating.
Fascinating, and unfortunately we ran out of time. We have multiple other questions on the chat. I must say we're gonna copy them, try to go back and answer them in either of one of our ICMA papers or directly via our usual sources. But listen, I found it a fantastic panel. I'm going to say thank you very much, Sam, who I see because right now on my screen, Camilla in Frankfurt, Patrick in Basel, and Olivier in Luxembourg. And just to close this forum for ICMA, Brian was talking at the very start that it's about technology reshaping the way we do things, how we think about things. It's about process and about product. We heard it from Cecile in the keynote, from the panel here. Adoption of change is required by literally everyone. The laggards need to catch up. We need to be paranoid and keep on being paranoid to the point of what we just heard on this panel. But at the same way, we know we need to look for standards. We need to go for global frameworks. We need to come together on a table to the point of Camella making. And it's great to hear from all of you that actually you think we're on the right track. We have done the first step for sure, but much more work is up on us. Yeah, and up in those who've been working and making money in the traditional world, yeah, things will change, because otherwise, to the point of Patrick, we might be left behind, and that's certainly not a great feeling. We don't want that. And with that in mind, I say again, thank you very much for my panel. Thank you very much for ICMA to organizing this forum, and hopefully our audience found this a useful and interesting morning. Thank you very much.